The year-to-date return of the S&P right now is the largest year-to-date return of any year going back. I'm going to make you feel really old here, Adam. Going back to the turn of the century. You've got to go back to the late 1900s to find a better return year than you're having right now. So the last 2 years have been absolutely phenomenal for stock investors. But just on a relative valuation basis, stocks are expensive, and there's no real getting around that.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good and tempestuous friend, Lance Roberts. Lance, how you doing?
I'm doing good today. How are you, Adam?
I'm doing well. Well, look, Lance, I picked tempestuous because there's been a lot of stormy action going on recently, sadly, with real storms here in the U.S. The American Southeast has gotten pummeled with two storms, Helene and Milton. Perhaps we'll talk a little bit about that at the very end here. But also the markets have a lot of volatility in them. And that was, actually, I want to give credit where credit's due. That's where Jam Carson, when he was on the program a few weeks back, was telling us to expect going into the end of this year. And he also said, hey, higher volatility does not necessarily mean lower prices. And so far, he's being proven right. And the day you and I are recording here, Lance, the markets have hit a new all-time high. All right, look, lots to talk with you about. I got to give a quick PSA. Before I do, I just want to give a nod to last week. You basically, the focus of our discussion was the fact that you saw a sell signal get triggered in the technical analysis. Is that sell signal still in play?
No, that sell signal led up to a fairly sharp sell-off that we had earlier last week. And then since then, the market rebounded from that. And with today's PCE report, not only did we break out the new highs, we triggered a fairly strong bullish buy signal that we talked a little bit about last week, but we'll get into that this morning. But yeah, it's everything looks pretty good right now.
Okay. All right, folks, I'm going to leave you on that cliffhanger just for a second to do my little PSA here. It is now just officially the day this video releases, 1 week away from Thoughtful Money's Fall Online Conference on Saturday, October 19th. So if you have not bought your ticket yet, folks, this is the time to stop procrastinating. Go get it now. Just go to thoughtfulmoney.com/conference, buy your ticket. If you buy it right now, if you buy it before midnight on Sunday, the day after this video initially airs, you can still lock in our last chance to save price discount. If you don't act by then, the price then goes up to the full ticket price. I want everybody to get the lowest price possible they can, which also, too, if you're a subscriber, a premium subscriber to our Substack, you'll get an additional $50 off the ticket price. So if you don't subscribe to the Substack yet, you might want to do that. Pay the $15 for a month, save 50, pocket the $35. Again, I want everybody to save as much as they can. If you're busy next Saturday or can't watch for the whole day, don't worry. Everybody that purchases a ticket will be sent a replay video of the conference within 24 hours or less, and we're pretty good on delivering on the or less part of the entire conference after it ends. You'll get all the presentations, all the live Q&A. You won't miss a thing. You can watch those replay videos to your heart's content whenever is convenient for you. All right, and then just a quick reminder that the mission of this channel is to try to help as many people as possible become as better educated as possible so that they can make the most informed decisions as possible about building their wealth. So it's very important to our mission to be able to offer as much high quality content as we can for free. And the conference is really one of the main ways in which we fund all these operations throughout the year. So if you want to help this channel continue to grow and thrive, and you're interested, obviously, in the information that we share at these conferences, really helps us out if you actually do attend them. Reminder too, I don't like to ask for money without delivering hopefully overwhelming value in return. We've got really the best faculty lineup we've ever had for an event. I'm going to run through it super quickly, then we'll get back to Lance. We've got Lacey Hunt kicking it off with a keynote. Every year, people say that his keynote is worth the price of admission in and of itself. We'll have Stephanie Pomboy, we'll have Darius Dale, we'll have Fred Hickey, we'll have Michael Pinto, we'll have Michael Leibowitz, we'll have Stephen Bavaria talking about income investing. We'll have Melody Wright talking about the housing market. We'll have Brent Johnson talking about the future of the US dollar. We'll have Lynn Alden talking about how to preserve the purchasing power of your capital from fiat currency devaluation. We'll have Rick Rule talking about natural resources investing. We'll have a bonus video from Jeff Clark on investing in the precious metals mining companies. And obviously we'll have Lance and the guys from New Harbor and Jonathan Wellham from up in Canada. So you'll be able to ask our financial advisors whatever questions you want. It's going to be an action-packed day, probably over 9 hours worth of presentations and Q&A. It's going to be a phenomenal event. Anyways, folks, hope to see you there. And again, to go lock your ticket in, go to thoughtfulmoney.com/conference. Okay, thanks everybody. With that out of the way, Lance, let's get back to the big red steak you just dropped off there. So we're seeing a bullish buy signal in the markets. What's the current TA telling us?
Well, so to get there, we have to step back to last week. And in last week's newsletter, we talked specifically about kind of what was happening in the background of the market. First of all, it's important to understand that we have just started earnings season on Friday. So today we saw earnings, on Friday we saw earnings from JP Morgan, Wells Fargo, BlackRock, et cetera. So that is the official start to earnings season, which will get real into the weeds this coming week. The week after, 2 weeks out, will be Apple, Microsoft, Google, all the big mega cap, magnificent seven stocks will report, and then we'll pretty much be done. That'll be about 80% of the S&P 500 will be finished up by the end of October. Also, stock buybacks come back into the market, so we'll have that bit of tailwind return to markets as well. But just real quick, let me share a couple of kind of screens with you to kind of walk you into just some analysis that we did last week, because we talked about 3 bullish and 3 bearish technical setups to try to navigate the markets into the end of the year. So this is analyst earnings for Q3. You see how they started out at $220 a share in March of last year. We're now down to $202.56. So we've cut about $18 a share off of earnings going to earnings season. Of course, this is why we'll have a fairly high beat rate of companies. We'll beat much lowered estimates. That's why we call it millennial earnings season. Everybody gets a trophy. So, again, I would expect that to occur. Now, in recent history, earnings season adds 3 to 4% to stocks on average. So in other words, through earnings season, we could very well see the market rise between 2 and 4%. So in earnings season, when you have normal earnings going on, stocks tend to rise between 2 and 4%. So we should expect a bit of upside bias to the markets going through the next couple of weeks in particular. Even though we don't have buybacks going on right now, we should see a relative lift to earnings unless something really comes out and surprises the markets in terms of earnings misses, et cetera. This is going to be the big focus for stocks over the next few weeks.
Hey, can I just ask you a question so you can integrate it into your answer here?
Absolutely.
Which is, you have been saying for months leading up to the election that stocks may de-risk before the election because of the election uncertainty, and that obviously seems to be a pattern for previous elections.
Right.
I think I just heard you say you think that stocks could pop like 2% or plus because folks are going to start beating these earnings. Mm-hmm. Have we already kind of seen whatever weakness you think we're going to see prior to the election? Because it's only 4 weeks away at this point.
Yeah, well, yeah, it's about 3-4 weeks away, and actually, Michael Leibowitz and I were having this conversation this morning when we were having our investment committee meeting, which is normally seasonally, right? We go back every presidential election year. We tend to see a little bit of de-risking ahead of October in October ahead of the election. Makes sense, right? You don't know who's going to get elected. You don't know what policies are going to happen, etc. So it makes complete sense. But, this year we had the sell-off that began in July, went through August. We had a fairly deep correction, 8.5% in August with that yen carry trade blow up. So a lot of that de-risking, and again, if you take a look at like hedge fund exposure, take a look at exposure of professional investment managers, et cetera, it's moving back up into more excessive exposure, but we're not there yet. So a lot of that de-risking got done in August and September. And so now there's not really a big need for that risk reduction that we would normally expect. Doesn't mean that it can't happen. We could still see, and right now, if you take a look at polls, just in the predicted polls, et cetera, Trump's building up a pretty good lead over Kamala. So, maybe that worries Wall Street a little bit about, a more contentious outcome to the election, et cetera, or, what, I don't know. I'm making stuff up here, but maybe there's something that can come up as we get closer to a week or two out from the election that maybe, stocks pull back a bit. But again, we're talking about averages. We're talking about, historical norms. And that's what, even with earnings season coming in, stocks on average tend to rise 2 to 4% during earnings season. Doesn't mean it has to, right? It doesn't mean it has to happen. It's just what it normally occurs. So we just have to kind of give a little bit of awareness to that, is the propensity of stocks to react to earnings, particularly if they're good.
Yeah, and so just ask my question a different way, given your explanation.
Yeah.
The probability of the market continuing to de-risk between now and the election, I imagine you think is lower than you did, say, a month ago.
Yeah, it has, because we took care of some of it already.
Okay.
And again, and two, the sell signal, the big sell signal we had back in June and July when markets were, very deviated. We were saying, hey, look, we're going to get a correction this summer. We resolved a lot of that big overbought condition. And, so when we got the buy signal, after that sell off in August, then we've had a bit of tailwind in September and now into early October. So again, look, markets are always risky. That's why they call it, investing is risk. And it's just, things can happen that we don't plan on, but we have to kind of play probabilities versus possibilities. And right now, the probabilities lean in the favor of stock exposure versus cash.
Okay.
Yeah.
All right.
So, but earnings continue to get downgraded. We're still quite a ways to go. Importantly, estimates are so far ahead of economic realities. At some point, you're going to get a repricing of markets. Forward PEs, as an example, are currently running about 21 times earnings. Forward PE ratios in 1999 were 25. Now, big difference between today and 1999. Everybody goes, "Oh my God, .com crash." Companies actually earn money today versus 1999. But just on a relative valuation basis, stocks are expensive, and there's no real getting around that. So and earnings, importantly, and corporate profits come from actual GDP growth. So unless you're going to have an absolutely stellar economy growing at 5 or 6 or 7%, it's going to be very hard to justify earnings growth at current levels of expectation. So we would expect to see over the course of the next year those forward earnings get ratcheted down a good bit, and that may impede some of the upside kind of potential of markets. Now, saying that, that's almost tongue in cheek, right? We're talking about a market that maybe grows at 6 or 8% over the next couple of years versus 25% over the last 2 years. If you don't know this, the market is up 54% in 2 years. That's a huge growth in the markets over a 2-year period. This year is a good example of this. The year-to-date return of the S&P right now is the largest year-to-date return of any year going back. I'm going to make you feel really old here, Adam. Going back to the turn of the century. You've got to go back to the late 1900s to find a better return year than you're having right now. So despite all of the negative headlines and, recession worries and all the other stuff that's going on out there, Israel, Iran, and elections and all this, the last 2 years have been absolutely phenomenal for stock investors. It's just been a phenomenal period to have money invested. And the great thing about it is that pretty much anything you bought went up. If you own gold, it went up. If you own stocks, they went up. Everybody looks like a genius right now. It doesn't matter what you invested in, you made money in it, which is good. I mean, that's great. Everybody's adding wealth to their portfolio. That's also helping, support economic growth right now. That's going to end at some point. I don't know what causes it to end, but we're going to see returns start to return back to a more normalized growth trend relative to economic growth, which should be around 6 to 7% a year, not 25. So, but that's going to feel like it sucks. We're going to go, man, I only made 6% of my money last year. That's terrible. No, it's not, but that's normal. But
right.
We've gotten so used to these outsized returns. It's quite phenomenal.
Right. So, and this is building off of many conversations we've had before, Lance, but it sounds like you're saying, that's going to normalize one of two ways. It's going to be sort of sideways action in the market where it just grows, but by a much more disappointing growth rate than we've gotten really used to. Or it could be more volatile than that. There could be a big correction there at some point. We don't know. And your job as the financial advisor is to say, hey, I could acknowledge the risk that trees don't grow to the sky, and this market's going to have to normalize. I don't know exactly the path of normalization, so I've got to manage capital in such a way that no matter which route it is, I'm shepherding my client's capital safely.
Right, exactly. So now let's get back to the technical aspect that you asked me for. That's all the background of what we're about to go into with earnings season and just some things to be aware of. But okay, so this chart, I've got two charts here from last week. So in last week's newsletter, in the Bull Bear Report, we laid out three bullish perspectives and three bearish perspectives. Technically, on this, just pure technical analysis, just technical analysis of the market, very basic 101 analysis. From the bullish side of the ledger, we had this very nice breakout above the previous highs going back to July the 15th. So we had a breakout to new highs. So that's good. We'd had the rally from the August lows. We had failed, right near the previous highs, came down, retested support at the 100-day moving average, 50-day moving average, and then rallied from there, broke out to new highs. Then the best part was, and this is last Friday we're talking, while we had that sell signal in place, we said, hey, look, the market came down and retested that breakout. Now, what we need to see is a confirmation of that retest. And so when you have a retest of a breakout, that's a good signal. That's a good bullish signal. But what you now need to confirm that breakout is a move to new highs, which occurred this past week. So now we have a confirmed breakout of this previous kind of consolidation that we had in July and August, which says that corrective move. And this is also one of the reasons why I don't really expect much of a correction in October, even though it's still possible, is because we've now concluded that correctionary process in July, August, and September. So that's now behind us. And one of the other things that we pointed out, of course, is this cup and handle pattern, which is a very bullish signal. So you have this kind of cup where you have a big decline, then you have a secondary decline that sets higher lows, and then you break out of that pattern. That's a completed cup and handle pattern, also very bullish for investors. Now, this is the key one right here. This is a rising wedge. So you have higher lows and a bit flatter tops. And so what you have is this price pressure that's ascending higher. So you have this series of higher lows that are coming along the bottom. And what you're looking for now, this particular pattern can be bullish or bearish. It's interesting because, again, you have these rising prices, but if for some reason the market would break down to the bottom side of this wedge, that compression of price is like a spring, right? So you kind of push the spring together, and then whichever way the price breaks out, you're going to get a decent move in one direction or the other. So if it breaks to the downside, then you're going to have a decent correction back towards the 50-day, the 100-day moving average, probably somewhere in there. If you break out to the upside, then that's also a very bullish move. And here is where we are as of Friday. Right now, this morning, we're talking on Friday. It's 10:30 Central Time as we're speaking. So again, there's some stuff that could happen by the end of the day. If this market rolled over and sold off, then we may not complete this pattern. But what would be ideal is that the market today finishes on the upside of this breakout of this wedge. And so as you can see right now, as of Friday, early morning, we're on a buy signal. Now again, this could reverse if by close of business on Friday, if the market reverses and rolls over and goes down 1%, that's going to keep that buy signal from occurring. So we'll still be on a sell signal, which we were on yesterday. So right now, as of 10:30 on Friday morning, we're on a buy signal. Just understand that how this day ends is going to be the important thing, right? So Fridays are very important because how you end technically on a Friday is both on a daily and a weekly basis, and that can really help define whether a breakout or a support level or whatever is actually valid. So if we can get this breakout on Friday and then hold that breakout through next week, in other words, we don't have a head fake here and the markets roll right over and go back down, then that would suggest that we've got a little bit move higher in stocks, at least over the next couple of weeks as we go through earnings.
Okay. Hey, quick question.
Yes.
You were up there on the MACD and said, and so we see a buy signal triggered here. Is the way in which you're pointing out that buy signal, is that the crossing of the 50 daily moving average above the 20?
No, it's so the moving average convergence divergence is the buy signal that we're looking at. This is the MACD. This is this top panel. Okay, so this is a 12-week moving average and a 26-week moving average, and so this is just the standard MACD. Nothing's we have some special versions of this that we use internally, but for thoughtful money and for your listeners and people who read our newsletters and those type of things, we use standard indicators for the analysis so that you can get them anywhere, right? So you can go to stock charts, you go to FinViz, wherever you get your charting from. This is the basic setup for a MACD. So I'm sorry, go ahead.
Yeah, I was just going to say, yeah, I apologize. I was reading the S&P 500 moving average key. The MACD, you're right, is a 12-week and 26-week one, right?
Right. Yeah.
Okay.
So the one at the top. So basic is what this measures is how far apart those two moving averages are. So are they converging or are they diverging, right? Are they getting further away from each other? Or are they getting closer together to each other? So this is basically a measure of momentum. If momentum in the market is slowing, moving averages will start to converge. If momentum if there's a lot of momentum to the markets and the markets are moving up very quickly, moving averages, the short one will diverge away from the longer one because the longer moving average won't move up as fast as the short one. So they get wider apart, right? So this is just all this is just making it really simple. It's a measure of momentum. The chart on the bottom is relative strength. So what is the relative strength of the overall market? That's what we're interested in. So on the price basis, we have this markets are holding above the 20-day moving average. The trend is clearly positive. We've now got 3 series of higher lows. We've now got 3 series of higher highs. So that's, no matter how you want to calculate it, that's bullish in terms of investing. Now, we do have some reasons for concern. Right. And now this is the one of the things that we note. And again, if you're not real familiar with technical analysis, I would really suggest going to our website and just clicking on our newsletter link under the Insights tab and click on last Saturday's report. It's called Technical Analysis, 3 Bullish, 3 Bearish. I kind of explain what's going on here. These are very simplistic analysis. Now, I know there's a lot of your listeners out there that are super in-depth technical analysts, and they're going to go, well, there's all these other things. There are about 1,000 different ways to analyze markets technically. This is just how we do it internally. As investors and portfolio managers, we are fundamental investors. We are buying stocks with good quality fundamentals, high liquidity, that have long-term outlooks. All that we use technical analysis for is to understand the risk that we have in our portfolio and do we need to increase or decrease risk. I'm not day trading stocks. I'm not buying NVIDIA on a technical breakout and holding it for 2 days and selling it. That's not how we manage money. We're long-term investors. So all we're looking for from technical analysis is risk management within our overall portfolio. So we use internally very basic technical analysis. There's Elliott wave, there's Fibonacci, there's all these other things that you can get into. More power to you. The one experience that I've had over 40 years of doing this is that the more complicated I get in my technical analysis, the worse decisions I make, because I wind up getting paralysis by analysis. Because for every one indicator that I can put up there, I can find 3 more that contradict it. And then I'm going, well, I've got 3 bearish, I've got 3 bullish, I don't know what to do, right? And so we don't do anything. And then that's where we make our worst decisions. So the one thing I encourage you to do is that you should use technical analysis in some form of your portfolio management, because it tells you what the psychology of the market is doing. You can have all these headlines, the world's coming to an end, there's a recession on the horizon, there's this, there's that, there's this other thing. Inflation's going to come surging back. What the market tells you is what the market is looking at. So you can be looking at this stuff over here, but the rest of the world is looking at this over here, and you're missing the bigger picture. So that's all technical analysis tells you. It just tells you what the market as a whole, which is millions of people analyzing data all at once. And there's buyers and sellers, and both sides think they're right. So, but this tells you who's winning that battle. Right now, the bulls are winning the battle over the bears. In fact, if you take a look at bearish sentiment right now, there are no more bears. They're gone. Bears have gone back into hibernation. because you just can't fight this market.
Right.
It's got that REO Speedwagon song, right? So
Which, by the way, I want to say this is reinforcing a current theme that you have made for years, which is um, you may have all the compelling logic in the world. You might even be proven right over the long haul. But if you're not positioned for how the market is actually trading, you can get slaughtered along the way. So it's your point is, be careful about your convictions, right? You have to be flexible enough to deal with the markets as they are, not as how you really, really, really are sure they should be. Yeah.
exactly, and like I've told you before, is like inherently I'm bearish, but we just have to manage the portfolio for what the market's doing. Now, I will note that there is some things up there on that same chart that says, hey, we also have to be aware of a bit of risk, which is that while the market may be breaking out, upside may be somewhat limited because we have in the momentum, which is the top chart, and the bottom chart, which is relative strength, we have what's called a negative divergence. In other words, the market is rising, but the momentum of the market has negatively diverged from the rising in prices. Relative strength has negatively diverged from rising in prices. Historically, when you have that type of a setup, markets tend to have a bit of a correction at some point in the future. Now, again, doesn't mean markets are going to fall apart, but they're between now and the end of the year, unless this rectifies itself and we start to see momentum and relative strength pick back up with the breakout of the market, we could see some more chop, some more volatility into the end of the year, and that would not surprise me at all.
Okay. Yep. All right. Well, hey, real quick, you just made an analogy pop into my head when you were talking about the importance of, or how you use TA. I sort of think of it like the fundamentals are your map, where you sit down, you plan your trip, and you say, okay, I want to go to this destination. I think this is going to be a good destination. So let's map the route and I'll get in the car. And the TA is really like your headlights, right? Which is, it's showing you what's going on the road ahead of you in the relatively near term. And
Right.
so, yeah, you might be going somewhere that you think is a really good place, but oh, there's a pothole over there, or a deer just jumped out of the road, or there's a wreck up ahead, right? So the TA is really kind of helping you navigate in the here and now on your way to the fundamental destination.
That's absolutely right. Yeah.
Okay. All right. So we'll get into what that means in terms of any portfolio allocation changes you guys are making, and obviously any trades you make. We'll talk about those in a little bit. Let me ask you this, because we got some a lot of data this week, and I've been looking forward to asking you this question all week, Lance. So we got some inflation data, right? We got the CPI numbers and we got the PPI numbers. They all more or less show inflation being a little hotter than was expected, right? Headline CPI grew more than expected month over month. It actually is down on a year-to-year basis to 2.4%, but the near-term action was a little bit hotter than folks expected. PPI higher than expected. Headline came in at 1.8 versus expectations of 1.6. Core, which strips out food and energy, up 2.8% year over year versus 2.6. And what's sort of notable about the inflation numbers here is that one of the things that was weighing down on these numbers was low energy prices, which are now rising again, right? So that's going to contribute to potentially a little bit more upward pressure on prices going forward. We also just got the University of Michigan inflation expectation data, and that has rebounded. So people are starting to expect a little bit more inflation going forward. Also, GDP is, it's pretty strong.
Yeah.
You just wrote a piece about this, but Q2 is basically, they've locked that in now at about 3%. You look at GDP now for Q3, it's at 3.2%. So my question for you, Lance, is what if we're reinflating? We don't necessarily have to make that call where we definitely aren't, but what if we are reinflating here? What would the implications be for markets if we realize, what, Fed didn't get inflation under control, it's beginning to go back up again? Is the Fed stuck in an Arthur Burns moment? But what would that mean for markets right now? Because markets don't seem to be priced for reinflation. In fact, Simon White of Bloomberg just released a post this morning saying exactly that. Hey, if we are reinflating, it's going to catch markets by surprise.
Yeah, and so let's go back real quick. About 2 months ago, you and I were talking here on the show, and we were talking about bonds, and I said, look, you can't buy bonds here. Bonds are way overbought, and in fact, I wrote a piece 2 days before the day before the Fed meeting, and said, very likely this is going to be a buy the rumor, sell the news type event for bonds. And the one thing you and I talked about is that there's a whole, bonds had front run this whole Fed rate cut to a large degree, and I said, all it's going to take is some data to come in a little bit hotter than expected. And when that happens, you're going to get all the inflationistas back out going, oh my gosh, see, we're having off the burns. The inflation's coming. No, it's not. First of all, let's just all sit down for a moment like adults, and let's just go through some data.
Okay. And just remember, my question was, what if it is? Not claiming it is.
So this is a table of the components of CPI. And there's two very important aspects that I want you to understand about CPI and the way that it's calculated. I don't agree with this table, by the way, because it's very arbitrary in terms of its weightings, because, Adam, where you live in California is very different than where I live in Texas. If I took my house in Texas and dropped it in California, I could retire. So,
gazillionaire,
yeah. And so inflation, the way that we calculate inflation, the way we look at inflation is completely useless. But we have to have the market needs some measure to judge inflation. So CPI is the best thing that we got. But here's some important aspects about it. Housing, which is the homeowner's equivalent rent, is 44% of the index. Food and beverage is 14%, and transportation is 17%. The rest of it is negligible, right? We talk about healthcare costs. It's 7% of the index. If healthcare costs surge off to the moon and housing drops like a rock, inflation's going down. It doesn't matter. You're paying more for insurance, right? Mm-hmm. Because there's not enough weight in that area. Recreation, education, communication, other goods and services, 2.7%. Energy, oil prices, is in transportation. That 17.2% contains energy in that component. So when you look at transportation, it's not only car prices, it's also oil prices. So that's all in there. So, but if you take a look at housing, this is a month-to-month number for each one. So it goes back 5 months, May, June, July, August, September, right? Housing went from 12.97% to 12.2%. So you had a big drop in housing, but food and beverage, which is 14% of the index, went up from 5.6 to 6.1. That's not really surprising because we're moving into, October, you got September, just everybody's back to school. Kids are coming, you're packing lunches now, sending kids to school. So not surprising, we saw a little bit more pressure on food and beverage prices last month. The anomaly came in transportation, which is up from 15.3 to 16.8. That has a little bit to do with oil prices, and that may carry through to next month. But when oil prices reverse, remember about 2 months ago, we were talking about buying energy stocks because oil prices were so oversold that we were going to get a nice reflexive trade in those prices, and exactly what happened. We're now pretty much done with that trade. So we're likely to see oil prices start to cool off as we head to the end of the year. So that'll start to back that up a bit. There was also in apparel, that big jump. We went from a decline last month of negative 0.61 to 1.35. So you had this huge, now apparel only makes up 2.5% of the index, but you had this huge jump in apparel. That was an anomaly in the data. That's going to get revised out next month. So what you're seeing right now in CPI is likely very transient. And also remember, this is the key point. We measure inflation on a year-over-year basis. So when you're looking at CPI and going, oh, look, inflation's higher than it was, this time last year. Well, yeah, last year we were also starting to print some fairly low reads. What was going on in October of last year? Remember, we had a 10% market correction. Everybody was super bearish. The economic data was slowing down really sharply, and so you had fairly low readings in CPI. We were having a very sharp drop in inflation last year. So now when you have a 0.1 or a 0.2% read, you're comparing that to a 0 or a 0.1 from last year. So it looks like inflation's printing higher, but realistically, all we're doing is just returning to normal. So that's what this chart shows. If we just print 0.2% every month, which is if you take a long-term look at the monthly changes of CPI, it's 0.2%. That's why every month they go, what's the estimate? 0.2. It never changes. It's 0.2. The reason is because that's the monthly change going back to 1990, sorry, on average, it's been 0.2. So everybody says, well, it'll be 0.2 because that's the average. So if we just do 0.2 in April, inflation will be 1.9%. The Fed will be able to say in April, we have gotten inflation down to our target of 1.9%. It will then rise to 2.4% by the end of the year. Now, why will it rise to 2.4? Who can do simple math? 0.2 times 12. Adam, what is that?
I think that's 2.4.
That would be 2.4. That's why your average long-term inflation rate is 2.4%, because it's 0.2 a month. So all we're doing is returning to normal. And as inflation returns to normal, we'll get back to between two. It'll vary. It'll go up and down a little bit, but we'll vary between, depending on if you have strong economic growth, we may be at 2.6% inflation. If we start to decline economic growth to say 1% growth, we're going to get down to 1.5% inflation. And that's why inflation moves up and down. But the long-term average, guess what? 2.4%. So all we're doing is returning to normal. And so this is going to process its way through. The Fed will continue to cut rates, although they will start cutting rates slower. I told you before, I thought the Fed should cut rates only 25 basis points in the first meeting, give themselves some breathing room. Mm-hmm. I think they're regretting that decision now. But we'll see if they cut rates in November. But it'll be 25 basis points if they do. It'll be 25 basis points in December. And then we may see a pause in here somewhere as we start to kind of see what the economic data looks like. If the economic data really starts to weaken, if the employment really start to slow down or unemployment pick up, we'll see what happens with this month. That number, right, that 245 in employment, that's kind of a shady deal. We'll see if there's a big revision of that number or not. But again, if employment starts to slow down, we could maybe see the Fed become a little bit more aggressive, because that's their big concern right now. Yeah. Now I'll say, with the recent headline jobs data, there does not seem to be trouble in no. the labor market. No. You and I have talked a lot about our suspicions above and beyond just the headline data, and I'll leave it at that, so we don't rehash that all over again today. But if the Fed is navigating by the headline data, yeah, it makes it really hard. Like a pause wouldn't surprise me at all, based on that. I think it would surprise the markets. I don't think the markets are priced for a pause. Yeah, probably not. Although, as we talked about, the odds for a 50-point basis cut completely went to zero when that latest jobs data came out. So the market is tempering its enthusiasm for rate cuts, at least we'll say. Yeah. All right. Well, look, so obviously then, Lance, if you're expecting by that math, which I totally get, that through the process of normalization that the CPI, headline CPI, could be below 2 in April, then that's a big part of your confidence in your bond trade, right? Because basically interest rates are largely a function of inflation expectations. Let me ask you this. The yield curve has been steepening, and some might call it a bullish steepening because the Fed is bringing down the short end of the curve. But at the same time, at the longer end, yields on the longer end have been going up. You don't have to agree with this. In fact, I'm going to bet you probably won't. But I interviewed Bill Fleckenstein earlier this week, and he isn't saying this is indeed happening yet, but he says he's seeing the signs that he would expect to see were this to start happening, where he's like, look, I don't think inflation's under control, so he differs with you there. And he says, I think the bond market is sending signals that it's losing confidence in the Fed, and that's why longer end yields are going up. So I know you disagree, but my question is just, again, it's not a what if. What if this turns out to be a bearish steepening and not a bullish steepening? What if the Fed has to eventually pause and the longer end of the curve still goes up? What if you determined that were happening? And I know you don't think it's going to, it's likely to happen. If that were to happen, what would you do? Well, again, if so, in order to make and look, it's great commentary, right? And I appreciate it's well thought out commentary, and I don't have any problem with it. It's just a view, right? And in order,
and this just makes a market. Smart people have different opinions. Yeah, exactly.
View is different than their view, but the one thing that everybody fails to address, and I was watching a video. I was sent repeatedly a video this week of another gentleman who shall remain nameless talking about the end of the bond bull market, and this has been commentary that's been going on for quite some time, and they fail to understand the dynamics of why interest rates and yields. It's simple. Their arguments are always the same, which is, well, yields are low, so they have to go up. That's the basic premise. James Grant, that was his argument. And but you ignore the drivers of what moves yields over time, and it's not just one factor. Mm-hmm. Yields are a function of supply and demand. So if, as an example, right, the Fed's very worried about the economy. Obviously, that's because the economy is what drives earnings growth. It's what drives economic growth. It's what drives wages and those type of things. So the Fed is always focused on this. Well, what is the big driver for the economy? What's the one thing that drives the economy above and beyond everything? What is it? It's debt.
Debt. I was going to say credit. Yeah.
And I'm not talking treasury debt. I'm talking bank debt, right? So companies have to go to the bank. They have to borrow money, and they borrow money. They put that money to work, building businesses, doing CapEx, whatever it is they're doing. That drives economic growth. It creates jobs. So the linchpin to the economy and the linchpin to inflation and everything else is a function of lending. Money is lent into existence. Yields are derived by the supply and demand for loans. So in other words, and now let's back up one more step. How do banks make money? Right? Banks make money loaning money. That's their business, right?
They make their money on the spread. What am I charging for it versus what's my own carrying cost? Yeah.
They used to make money on ATM fees and checking fees and those type of things, but those all went to zero, right? So now they make money making loans. And this is why the Federal Reserve is so very tied to the health of the financial banks, because they are the backbone of economic growth. So if the bank says, okay, hey, I need to loan money and my interest rate is 8%, and business owners go, yeah, I'm not borrowing at 8%, it's too expensive. Well, they're not going to borrow if the cost of capital is above the return on investment that they can make from whatever they use that capital for. In other words, if I have to borrow at 8 and I'm going to build a plant that generates a 4% rate of return, why would I do that, right? My cost of capital has to be lower than the rate of return on whatever I'm using that capital for. So if the rate is too high, banks have to lower that rate. If the banks can't loan money because the rate they're being charged by the Federal Reserve is too high, the Fed has to cut their rate. So in other words, yields are a function of economic growth. And we've gone through this analysis about a bajillion times here on the show, so I'm not going to go through it again, but yields are simply, and there's a very high correlation historically, yields are a function of inflation, economic growth, and wages. And as wage growth slows, as economic growth slows, the demand for loans will slow, which is already happening, and that brings yields down. Now, it doesn't mean yields go straight down. They're going to bounce around, and that's why technicals are important. But again, you're going to have this movement in the markets, but ultimately, at the end of the day, it's going to track inflation and economic growth. So now let's back this whole argument up. So everybody's saying inflation is coming back. How do you get inflation when you have 35 trillion in government debt, record corporate debt, record household debt? People are leveraged up their eyeballs. And if you raise rates too much, they can no longer borrow or spend money. Mm-hmm. Right? So you cannot get inflation. You cannot have an Arthur Burns moment, because we don't have an economy where the household debt to net worth ratio is less than 60%. We're at 150%. There's simply no ability. And if you actually take a look at, we actually talked about this in today's article. I'll just show you a real simple example of this. So what this shows you is something very important. This is PCE. This is personal consumption expenditures as a percentage of GDP. That's important because PCE is 70% of GDP, right? PCE as a percentage of GDP has not grown since 2000, even though household debt is continuing to increase. And this is because it's taking more and more debt to generate the same living standard. In other words, consumers are having to consume the same amount of goods and services. Stuff's just costing them more, and they're having to do it on debt. So more debt is not leading to stronger economic growth. Look at the period from 1970 to 2000. Look at that elevation. We went from under 60% of PCE as a percentage of GDP to 68%. And we've been stuck there ever since. We just can simply not grow anymore by using leverage. Because again, previously we could buy all this stuff. We could buy houses and cars and boats and planes and trains and everything, buy it on debt because nobody had any debt. They're now leveraged to the hilt. So there's an inability of debt to create more economic growth. And if you have an inability to create more economic growth from debt, you cannot have inflation.
Okay. All right.
Sustained inflation. You can have bouts. Like if you're going to send checks to households and shut down the economy, you're going to have inflation. But on a normalized economy, you cannot create inflation from debt.
Okay. And let me ask this last question, and then we'll move on. We are in, I mean, what one could call a reinflationary macroeconomic regime,
Sure.
meaning that the major world economies, as we've talked about here, have now all reverted back to rate cuts and or fiscal stimulus. So it doesn't sound like you're terribly worried about that impacting, say, your bond trade.
Right. Well, no. So cutting rates is not inflationary, right? We cut rates to zero and had no inflation for 15 years, right? Since from 2009 till 2020, we had no inflation, even though we cut rates to zero. Stimulus doesn't, in terms of like quantitative easing, which by the way, we're still tightening that balance sheet. We're not doing QE yet, but QE and interest rate cuts don't create inflation. There's no evidence of that. What creates inflation is shutting down the economy and sending checks to households when you create artificial stimulus, artificial demand by giving people money. So as long as we don't go back to sending, now, if we go back to sending checks to households, bond trade's over.
Yeah. But if we get there, and sorry, I'm just going to make your point for you. I mean, if we get to that stage, that's going to be in response to a crisis. Going into that crisis will highly likely have made your bond trade really successful up until the point of the stimulus gets unleashed. Okay, yeah.
But just to conclude this real fast is that, look, as I talked about last week, there is a terminal rate on bonds, on yields, right? Yep. We're still fishing for where that terminal rate is. It could be 2, it could be 2.5, it could be 1.5. We don't see any evidence right now that we've reached that terminal rate. When you and I were talking before, when I said bonds are really way too overbought to buy, I said yields could probably back up to about 4, 4.1, 4.2. We're right in that target range. Just from a technical layout, this is kind of where we are. We were 3 standard deviations overbought previously.
There we go.
Yep.
Now we're seeing it.
Yeah, we were 3 standard deviations overbought previously. We're now 3 standard deviations oversold. We're extremely oversold on every single metric for bonds. So, we're actually looking to add to our bond portfolio at some point. We're going to drop it. We're going to extend duration here a bit, shift some of our intermediate term to longer term duration bonds, because there's a nice trade that's getting set up in here back into probably the mid 80s. And then we'll rebalance probably at some point, but we'll continue to trade this for a while. But the trend is now turned positive, and there's nothing that suggests at this point, unless we have just checks being sent. For some reason, there's checks getting sent to households for no reason, right? We have an election, and first thing out of the election, I go, well, guess what? We're sending everybody $2,000. There you go. UBI is back. Then, yeah, we're going to have inflation. We'll shut down the trade. But again, right now, if I'm an investor and I can pick up 4%, 4.1% on a 10-year treasury, and this is where we've got to get our head around investing a little bit. If my goal is to generate 6% a year on a portfolio, I don't have to work real hard right now. I take 50% of I'm using these numbers for simple math. So however you want to do your math, that's up to you. But let's say I take 50% of my portfolio, I buy 10-year treasuries at a 4% yield right now. So that's a 2% return on my money just from interest income. So if I want 6, I've already locked up 2. So now I only have to generate 4. So right now, if you take a look at our dividend equity model, you can really easily build a 3% yield portfolio on equities. So if I take 50% of my money and buy equities that yield 3% on average, there's another 1.5% in return just from dividend income. So now I've got 2% from my bond interest income. I've got 1.5% from equity. So now I'm at 3.5%. So now I only have to generate 2.5% on growth in this market out of my equities to get to my 6%. I don't have to take a lot of equity risk to get to 6% annualized. The problem is, as investors, we're wanting, well, the market's up 20. I want 20, right? Why do I want on bonds? They're going down. And I want to buy stocks. They're all going up. But this is where we get detached from what the purpose and goal of investing is, because we're chasing returns rather than focusing on how to build a portfolio that generates return over time. And that's why bonds are a very, very important aspect to your overall portfolio. They lower volatility, they increase returns over time, and they allow you to sustain volatility in the market. So when markets do whip around 10 or 15% and your portfolio is doing 3 or 4, that's very survivable. And that's what we have to kind of get back to the basis of, why are we investing in the first place? What is our goal? Are we simply just speculating in market returns? If that's the case, don't own bonds, just go buy a bunch of equities, you're good. Right? But if you're trying to generate kind of a quote unquote annuity that's going to kick off returns over time, regardless of what the markets are doing, start thinking about what the return rate it is and then build a portfolio to generate that.
So I so appreciate how you just described that, Lance, and that did a great job of I think helping people understand how a professional money manager looks at the process of it. I mentioned that Stephen Bavaria, the founder of the Income Factory, is going to be in next week's conference. And he has a good way of describing it, where he says, when Ford builds a new factory, right, the second the factory is built, they don't think about the market value of the factory. They're not tracking the market value of the factory, week in and week out after that. What they're looking at is, how many cars is this thing producing, right? Mm-hmm. And he says that's really how you should look at your portfolio, is you should be putting things in there and looking at the returns and what are the returns this thing is generating for me consistently year over year. Am I doing better? And optimizing the output of return and cash flows versus really caring about at any one moment what the market value is.
That's right. And that's and again, this is what I'm saying. Is like
but that's so how most regular investors don't think about it, right?
Well, that's my whole point. We get so look, I blame the media for this, right? Because every day the media is going, hey, look what the market did today. Did you outperform the market? Wall Street, everybody needs to step back and remember that Wall Street is here to sell you something. Right now, here's some good examples for you. 2020, 2021, right? We had this rash of IPOs, and since we couldn't get IPOs to the market fast enough, we came up with SPACs, right?
SPACs, even dumber idea, yeah.
Right. And so now we're not doing IPOs and SPACs, we're doing single stock ETFs. They're doing so many single stock ETFs, they're now running out of stock names to do these things on because you need a company that's got a lot of liquidity that can move a lot to make these things work.
Right, they're running out of tickers, yeah.
And so they're running out of companies available to do this with, because we're up to like over 600 different ETFs just trading single stock ETFs. And so, we built this market. So Wall Street wants you to compare. They want, and comparison is the root of unhappiness. And I use this example.
Thief of joy.
Yeah.
It's the thief of joy, right?
This example in the office the other day, I said, if I give Brent, who's my producer for the radio show, if I give Brent a Mercedes as a bonus one year, he's probably pretty happy, right? I mean, the guy drives like a 1990 Miata. He just loves this thing. But if I gave him a brand new Mercedes AMG, he's probably pretty happy. Well, he's happy until he finds out that I gave everybody else in the office 2 Mercedes AMGs. Now he's disappointed because he didn't get 2 when he got 1. Now, shouldn't 1 be enough? I mean, shouldn't we be happy with 1? But no, see, we're always comparing. And that's what Wall Street wants you to do, is they want you to compare, because when you compare, then you get unhappy and then you move money. Who benefits when you move money? Wall Street does, because money in motion creates fees. I moved from one advisor to another. And so, you're unhappy with your portfolio because you only did 10% this year and the market's up 20. Hey, I get it. So you go to this other advisor who promises you, oh yeah, we did 25 this year and we'll do 25 next year. So you go, okay, great, I'll move money. First thing he does is he sells everything you own and buys everything he owns, right? So you just created fees for Wall Street. And so investors are terminally jumping around from one strategy to another because Wall Street encourages you to compare to all these random things. And this is why they constantly come out with new products or new benchmarks to compare to or new things to compare to. Because if you're unhappy, you'll move money, which creates fees for Wall Street. It's not doing anything for you, but it's creating fees for Wall Street. So this is why we have to go back to the root of why are we investing in the first place? What was your goal? And everybody's goal is different, right? Some people want, look, I just want to invest. I want all the growth I can get. There's nothing wrong with that. Just understand the risk you're taking. I wrote a really important article this week on the website about Howard Marks and risk management. And it's
which we're getting to. Yeah.
Yeah, if you're managing your own money, I highly encourage you to read this article because you need to be able to understand and quantify what risk really is. It's very important to how your outcomes are. But back to the story is that you've got to determine what that goal is and then don't deviate from it. If it's 4%, 5%, 6%, 10%, whatever your number is, it should be realistic. But whatever that number is, focus on that. Make sure your portfolio is designed to do that. Make sure that the risk management's there for it. And you'll be fine, but you're constantly going to be tugged by performance of this and performance of that. No, I'm missing out on this asset over here. I don't own this in my portfolio. I'm missing out. No, you're not. If your portfolio is performing like it's supposed to, it doesn't matter that you don't have that one stock over there that went, 500% to the moon. It doesn't matter if your portfolio is working like it's supposed to.
Yeah, this is one of, I think, the great lessons of maturity, right? Which is realizing at the outset, the best thing you can do besides just leaping into action is to work on asking the right question and getting that answered. So, in your point, when it comes to investing, it's not what stock should I be in today or whatever, right? Or what's hot. It's what outcome do I want? What am I solving for? What are my goals? And then what do I need to attain that goal? And then how can I essentially attain that with the highest degree of probability possible, right? And
right.
So, to your point, you might find you only need 6% a year or 5% a year or whatever to hit your goals by your target date. Then you don't need to be stretching for additional risk, right? Because yeah, you might make more certain years, but you do so at the exposure of risk, and you may end up losing more in certain years as well, and you're going to have a lower probability of actually hitting your odds, right? Yep. So it's not like use my car analogy. It's like, most investors kind of get in the car and then just drive around, right? You don't know where you're going to end up, right? So it's first, before you get in the car, figure out where you want to go. Find the route there. And to your point, don't keep changing the destination along the way. Oh, no, I want to go over there now. I want to go over there now, right? So that's just the sign, I think, of maturity in life. I mean, the same thing is true in business, right? So many people that are doing lots of busy work, but it's not necessarily helping them nearly as much if they had just paused at the beginning and said, what am I trying to achieve? And then just done the few things they really needed to do to get the job done right the first time. You probably get it done with a higher degree of confidence in a shorter amount of time with less energy than just, trying to look busy the whole time.
Yeah, no, that's absolutely right.
Okay, so two quick things, and then I do want to get to your risk article because I thought that was great, and I'd love to, if you can, to kind of go through that 15 bullet point list of lessons from Howard Marks, or at least just cherry pick a couple that you think are really important.
Absolutely.
But to your point about Wall Street, obviously it exists to serve itself, not you. Everything there is to trap you into creating fees for Wall Street. This whole thing about comparison and Wall Street trying to trigger you on that, we've talked about this at length in the past. I won't go into depth, but this relative comparison and how it drives our sense of happiness and justice or injustice is like deeply evolutionarily embedded in our wiring, like really down in our limbic systems. I think I showed the video, I don't know, it's probably a year ago or so, Lance, here on one of these videos with you, of the capuchin monkeys, right? Yep. Where they're fed cucumbers to do a task, and they're happy because they like cucumbers, right? And then one of the monkeys starts getting grapes for the same task, and monkeys like grapes better than cucumbers. And the other monkey goes ballistic, just throws a massive fit because he's not getting grapes all of a sudden, right?
Yeah.
And it's in the animal kingdom that we compare ourselves relatively to those around us, and we get wicked pissed when we feel like someone's getting preferential treatment to us. So they're trying to press that emotional button in you to get you all riled up to take this action. So you got to be aware of that. And this is reminding me, it's probably time for me to bring Robert Cialdini back on the program. I interviewed him a couple of years ago. One of my favorite interviews of all time. Folks, if you don't know who Robert Cialdini is, he wrote the book Influence, which is one of the seminal best-selling books on marketing. And he's a behavioral economist. And it's basically research that shows the ways in which humans get persuaded, oftentimes in ways that we're not conscious of. And this is used by marketers, it's used by politicians, it's used against us a zillion times every day by people who are trying to get us to buy their product or vote a certain way or take certain behaviors or exhibit certain behaviors. And most of the time we're unaware of it. And Cialdini himself, the expert, says, look, I think I'm better than most people at avoiding these things because I'm the guy who wrote the book, and I still, fall victim to these things pretty frequently as well. It's a fascinating book. He's got so many unbelievably interesting research case studies that sort of prove these seminal points about the levers that get pulled in us to force us to make certain decisions, oftentimes, like I said, against our will or just unknowingly. So if folks are interested, let me know. If you'd like me to bring Robert back on and revisit this topic, it's super interesting. And it's actually some of the most useful knowledge I've ever come across in my life, because once you see through his lens on how people are trying to influence you, you can see, a much greater percentage of the time it's being applied on you, and hopefully you can, reduce its influence over yourself. All right, so let's move on to this this risk piece, and then we'll get to your trades, Lance. You say at your core, you're kind of bearish about things, but we have to play the markets that we have, not the markets that we wish we had, which means I think you got to go into them with a good appreciation for risk, right? That like, okay, the getting is good now, but it is probably not likely to always be good. So what do I need to be doing now to protect myself for if indeed when fortune reverses, I'm not just caught flat-footed by it?
Yeah, no, that's right. Like I said, it's inherently, I'd say I'm bearish, and I guess bearish really isn't the right term. I'm inherently cautious, right? Because I'm dealing with other people's money. If it comes to my money personally, I'll take big risk. That, I'm okay with that, because if I lose, it's just my money, and that's fine. And I've invested in businesses that didn't work, and I've done, I've invested in businesses that have worked great, and I've lost money in other stuff, but that's just me inherently. I'm willing to risk capital, but when it comes to my clients' capital, I'm not willing to risk it. So,
right. And sorry to interrupt, but I also think, just knowing you do have concerns about the fundamentals of the macroeconomic situation.
Absolutely.
Yeah.
Yeah,
okay.
absolutely. Earnings, valuations, economic growth. Yeah. Debt. I'm as concerned about the debt level as anybody else, but not from the standpoint that I'm worried about the country going bankrupt, because we won't, because we have the ability to print currency. I am worried about the impact of debt on economic growth and economic prosperity, which has been clear that economic prosperity is weakening in the US, not getting stronger. And that's a function of the debt. But when you're investing, and especially when I'm investing other people's money, we have to understand what risk really means. And this was the juxt of the article that I wrote. So if you want to read it, it's on the website, or it's on my Substack page as well now. So at Lance Roberts on Substack. If you're already over there with Adam, just subscribe to the channel, and you can get all the articles there as well. Just trying to make it easy for everybody. But risk is not about risk isn't just volatility. So, we were talking about volatility earlier. Volatility has been rising in the market, and usually that precedes a correction. Not always, but more often than not, if you have a period of rising volatility and a market that's going up, generally the market loses out to volatility because something's going on underneath the surface. But risk isn't just that. Risk is a function of losing money. And a lot of people run around and go, well, I want to take on more risk because I want to make more money. That's not the way it works. taking on risk to make more money is like, well, the more risk I take, the more money I make. That's not true, right? If that was true, you could jump out of an airplane without a parachute and survive, right? That's not going to work out well for you because you're taking on unnecessary risk. Risk is the probability of losing money. And the more risk that you take, if something goes wrong, the more money you're going to lose. And think about this, the stuff that you do in your everyday life. You don't get on the freeway and drive 150 miles an hour because if something goes wrong, you're dead, right? You may speed a little bit over the limit. You may push it a little bit over the limit. You know, the speed limit in Texas is 70 on the freeways, so maybe you'll go 80, but you're not doing 140 because A, you don't want a ticket. B, at over 100, you go to jail. But C, if you have a flat tire, you know, if you have a blowout driving at that speed, you're done, right? And people inherently know that risk. So they'll push a little bit of risk, but they won't take all the risk, right? Same thing in investing. Take on a bunch of risk, the outcome's not going to be what you like. He also goes to talk about asymmetric investing, which is something that we really focus on with our portfolio models, which is structuring the portfolio so that your potential gains are larger than your potential losses. Mm-hmm. And that has to do, and look, the investing, and this is one of the rules we get into, you cannot avoid risk and you cannot avoid losses, but the goal is to structure the portfolio so that your gains outweigh your losses more often than not. You know, and the problem with risk is you can't quantify it. There's no measure of risk. You can't look at your portfolio and say, oh yeah, I've got X risk. Can't do it. There's no way to calculate it. We can look at standard deviations. We can look at a lot of different measures in terms of volatility and beta and all this other stuff, but there's no exact measure of how much risk there is. So there's no way to know if the market goes down 20, exactly how far your portfolio is going to fall. But we do know that if we build it correctly, we can minimize that risk to the downside. And then there's, of course, all the risks that we don't talk about, right? So when we think about risk, we focus mostly on the risk of losing money, but there's also other risks that you have to be aware of. And one of the risks that we often overlook is missing out on gains. And in other words, we become so cautious in our portfolio or how we're invested that we miss out on the gains of the market. And again, more money's lost by not participating than actually participating in the markets. Look, simply the future is unpredictable. We don't know what's going to happen tomorrow, much less next week, next month. Anybody telling you what's going to happen a year from now? I don't know. Nobody knows. We barely know what's going to happen next week. I mean, with technical analysis, I can give you a pretty good idea of what will happen from one week to the next. But outside of that, it's pretty much a guess, and anything outside of that is luck. So it's very unpredictable, and risk can be very deceptive. And so that's why we have to be careful about how we approach the portfolio. This is what I'm saying earlier, you know, set that goal and you can build with interest income. And really, this is the first time you can do it for the last 15 years. You can build a decent income stream in interest and dividends alone, which for a long time you couldn't because there was no return on bonds, right? There's just no yield. So now you've actually got a really good opportunity to kind of annuitize your portfolio, so to speak, create this income stream. And remember, there's three stools to a portfolio, right? There are three legs to the portfolio stool, which is interest income, dividends, and capital appreciation. So if you're missing one of the legs, right? I have no bonds, right? So I'll lose out on interest income. Now I'm dependent on just two of those legs of the stool to generate my income. If I own only dividend, tech stocks and nothing yields dividend, now I'm down to one aspect of my portfolio, and I've got to be 100% right on that one leg. At least if I have diversification, I have all three legs of the stool, I've got a much better odds of winning the market over time and getting to my goals. So that, so again, there's more explanation for each one of those, but we have 15 rules that we've written, and this is kind of the crux of our investment strategy, and we share this on a regular basis from time to time, and we put it back in the article today. But talking about, these are just the risk management rules, right? So we talk about cutting your losers short, letting your winners run. Look, in this market right now, everything's going up. If there's something in your portfolio that's not going up, it's not going to go up when the markets are going down. It's probably something fundamentally wrong with it. and let that go for the time being. Doesn't mean that you're a bad investor, doesn't mean that you're stupid, doesn't mean that you're ignorant. It just means that there's something wrong with the company and it's just not working right. And that's it. So just be good with that. Be okay with the fact that you made a mistake. Set goals and be accountable. Like we just talked about a second ago, set your goal, be accountable to it. If your goal is 6% a year, when you get to 6% a year, lock it down. Take money out of the market. That doesn't mean sell everything, but if you get your 6% by October, November, trim back the risk some. So I've already got my gains. It's kind of sitting at a poker table. Don't keep betting every hand, full bore, because eventually you'll lose. I've got an article on this Tuesday talking about a kid. He's now suing RBC. He turned $88,000 into $415 million. And he's blaming RBC. It was all their fault that he lost it all.
He lost it all. I saw that.
Yeah. And so I go through, but this goes right to the point, right? Is that he was taking on this incredible amount of risk, leverage, margin, option trading. This was all between 2020 and now, when everybody was just speculating in the markets. And, just common sense would tell you that once you turned your first 100 million, which is phenomenal, by the way, why wouldn't you take 20, 30 million and stick it in the bank, buy a treasury with it, right? That's just greed. All that is once he started compounding returns, that just became pure greed. Oh, I want more, I want more and more. If you're at 400 million, at what point do you just say, I'm done, I'm out, I'm going to go live on a beach? How much money do you need? So, importantly, set goals and be accountable. When is enough in terms of your annual return? Because again, this is where we get in trouble. Oh, the market's up 25. I got to be up 25, right? That's where we get into trouble.
Hey, Lance, I'm going to inject you just because I know folks are going to shoot me for this, but we're getting tight on time given your deadline here.
Yep.
So if you can't make it through all these, we'll just direct people to the website to read the rest.
Well, there's only three. I was going to hit three other ones that are real important, just real fast. Right?
Yeah.
Number 7, lucky number 7, losing money is part of the process. Expect to lose money when you invest. If you're investing money, expect to be wrong sometimes. That's okay. Markets are either bullish or bearish. And if markets are bullish, be bullish. If markets are bearish, be bearish. Don't get hung up on one side or the other. And particularly if the market's going against you, that's where you've got to start changing your direction. That doesn't mean that you, like, for instance, with bonds right now, bonds are going down at the moment because they were so overbought. Technically, we had to have this correction. That doesn't mean that the trade is wrong, right? So bonds ran up. We had a great return in it. We took some money. Now, with this, and we're starting to shift the portfolio around a bit. So now they're pulling back, giving us some opportunity to buy some more, right? So, but if at some point that dynamic changes, if something economically fundamentally changes, we'll change our story and we'll say, hey, we're done with the bond trade. We hit terminal rates, whatever it is. So just, and most importantly is number 12, which is do more of what works and less of what doesn't. And if you just do that, you'll be a better investor over time.
Okay. And obviously, folks, a lot of these things are these are hard-won lessons that Lance and his team have made over the decades. Some ways sort of, easy to say, takes a lifetime practice to do well. Highly encourage everybody to read all those risks and to try to incorporate them into their investing practices. But I do think, in most cases, for most people that have real lives, real jobs, other things they need to focus on, your better focus is probably not trying to apply those to what's the next best stock to put in my portfolio, and more to who's the best advisor who epitomizes and employs these things so that I can let their expertise be my guide in this story. All right, Lance, let's see here. I had a good rant. We were going to get into some of the better sides of humanity that we sometimes see coming out of tragedies like we've seen with Helene and Milton. I don't want to do that short shrift, so we'll try to do that next week.
Good.
I guess let's get to your trades first. What trades have you done over the past week?
None. We actually did a good bit of trading over the last couple of weeks and kind of positioned for kind of where we wanted to be going into the election, right? So we shifted some of our cash into a little bit longer duration. So we kind of went from 1 to 3 year cash money to 5 to 7 year treasuries, so just a little bit. We kind of rebalanced some of the equities in the portfolio. And we talked about those trades here over the last couple of weeks. So we're actually just kind of in a good position right now. In fact, the interesting thing is that every day this week, Mike and I and Nick have been sitting around the portfolio going, I honestly don't know what to do. And everything is working like it's supposed to be. We're having good rotations within the markets. We talked about buying energy stocks a couple of weeks ago because energy prices were so oversold. So they've come roaring back. They're doing fine. Some of the tech stocks, we added JP Morgan to our portfolio a couple of weeks ago because we needed some financial exposure going into earnings. JP Morgan's up 4% today. So, that's doing well. So again, it's like we're just kind of in this really weird period where the markets are doing well. We know there's some risk out there, but there doesn't seem to be any real catalyst right now that would suggest that we need to, sell something or reduce risk. But at the same time, everything that I kind of want to buy, if there was a stock I wanted to buy as an example, it's super overbought right now. I just literally can't buy it. So, it's just this weird period where I'm stuck, where I really can't do anything, but I don't really need to do anything either.
Okay. All right. And again, that's probably a testament to you following your rules and your process so closely that, even though it's a tough market environment right now to take new positions, you're content with what you got.
Yeah.
All right, real quick. I just want to note two things about the conference. One, you were talking about how this is a particularly good time to build cash flow, design a portfolio for cash flow. That's one of the reasons why I'm so excited that Stephen Bavaria is going to be at this coming conference, because he goes into depth, not only in terms of the type of assets that he's using to construct an income factory, but he shares an awful lot of tickers. I just talked to Stephen the other day, and I know he's got a lot of specific tickers that he's sharing, so that'll be useful for folks. Also, you talked about the stool legs and how if you have fewer legs, you're putting a lot more work on the remaining ones. To the folks that are really heavily into growth, again, Fred Hickey is going to be at the conference. To put it extremely mildly, he has a lot of doubts that the Mag 7 trade is going to continue to do as well going forward as it's done in the past, because of, from his research, the growing realization amongst capital, amongst IT executives that they're not getting the return that they've been hoping to get off of their generative AI investments, and that there very well may be a decrease in CapEx going forward in that space. And if so, there's a lot of dominoes that could fall. So if you have, if you're just one of those, tech bros that's all in on a Mag 7, Fred Hickey thinks that you might be setting yourself up for disappointment. Of course, you'll find out more about that in the conference itself. All right, so just some things that we're going to bring out in the rant that I'll just let folks know about. One is, one of the lessons you learn from socially and culturally going through tragedies like a devastating hurricane is the importance of social capital. And Lance, you and I have talked in the past about one of the best books I've read on that topic is Tribe by Sebastian Junger. That's the guy that wrote the book, The Perfect Storm. I got a chance to interview Sebastian about a week ago. So I've got the interview done. I don't have a slot for it on this channel anytime soon. So I just want to let folks know, if you're interested in that discussion, I'm going to share it with my Substack audience. So if you don't already sign up, if you don't already signed up for the Substack, go sign up for it now. Just go to thoughtfulmoney.com/newsletter, or go to the Thoughtful Money website and click the newsletter link. And I'll send it to everybody on Substack, the free and the paid. So you don't have to pay anything for it. I don't know exactly when I'm going to release it in Substack, but probably some point over the next week. Really good discussion, super important topic. And again, maybe we'll pull some of the highlights of that out, Lance, when we talk about this topic next week. I also did record an interview, I think a very important one, with Dr. Stephen Camarata, who's the head of research at the Center for Immigration Studies. So we did do the deep dive into what are the facts of the current immigration system, both legal and illegal, and the current state of the US border. and how that impacts the economy and how that's impacting society. I think it's definitely a data-rich deep dive. I think we did a really good job of keeping it very apolitical, very respectful of all parties. That also is going to launch at some point on this channel, probably a lot sooner than I'll ever be able to get the Sebastian one to be on this YouTube channel. Probably going to release it in the next week or so. But I have let some of the folks on my Substack watch it. Feedback has been very good so far. I just want to let folks know that I actually delivered on that commitment, and that video will be coming soon. All right, just in wrapping up here, Lance, I feel bad. I'm going to share my screen and be transparent about something I did that maybe I shouldn't be terribly proud of. Let me see, not that one. Here we go.
What'd you do?
Yeah. So I did ask this YouTube audience to do me a solid last week, because you and I were so close in our Twitter counts. I put this out there.
Oh, that's hysterical.
It said, "Hey folks, I'm just behind Lance in followers on X Twitter. Can you help me out?" For those that are listening on the podcast and don't have a visual, I put up a nice picture of Lance with the words "Beat Lance" on top of it. And so the outcome of that, Lance, is
Your head down?
Here you are at 86,500 X/Twitter followers, and my audience helped get me to 86.6.
Nice. All right. So audience, if you're watching this video, go to Substack, follow me there so I can get ahead of Adam on Substack. I'm all free. Everything is there. I don't charge you anything, but go to Substack at Lance Roberts and get me ahead of Adam.
Fair is fair. And I actually had here, I wanted to ask my audience to go to your Twitter and to follow you on Twitter too, because I felt so bad about all this.
No, I think look, I am so unimpressed with social media. I could care less. It's so funny because my kids are so ate up by it, right? They just like, oh, look how many followers I've got. I've got like 12 followers. I'm like, that's great. I'm happy. I don't get me wrong. I'm so grateful that, people follow me on Twitter to see, we post daily market updates and little commentary bits here and there about the markets, what's going on. And I'm super grateful. But I've never really understood the benefit of it.
Well, you didn't grow up with digital media the way that obviously I did. I just got a lot of comments, very well deserved, which is like, what are you, Adam? You guys like 12-year-old boys, competing with each other? And I'm kind of like, yeah, that's kind of what we're doing here. Yeah. It really, the only thing I really got out of that I wanted was the ability to just do a little public twisting of the
Gotcha. It's all good. It's all good.
Here.
I'm completely I hope you make twice as many followers as I have.
I know. Well, folks, like I said, I want you to go follow Lance so he doesn't feel too bad. All right. Well, look, if the thing that does give you the greatest meaning in your life is tuning into Lance Roberts every week on this channel, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. We did a really good job. Lance did a really good job this week, I think, of really modeling what a really good financial advisor does in terms of managing client capital and focusing on the prize and not getting distracted by all the human elements, all the market distractions, all the risks that are out there that Howard Marks have mentioned. If you've got a good financial advisor who is being your financial quarterback, implementing those practices, great, stick with them. But if you don't have one like that and you think you might want to have one, feel free to schedule a free consultation with one of the financial advisors that Thoughtful Money endorses, perhaps even Lance and his team there at RIA. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. The advisors will be in touch, usually within just a couple hours, to get something scheduled. I won't go through the whole song and dance, but you only have a week left to sign up for our conference if you haven't done so yet. For all the reasons I mentioned at the beginning of this video, go to thoughtfulmoney.com/conference. Lock in your ticket now, especially lock it in before midnight on Sunday so that you get the last chance to save price. All right, Lance, as usual, I'm going to give you the last word.
Yeah, so if you really enjoy this every week, go buy my Substack at Lance Roberts and subscribe to my Substack. You won't get a discount on anything because it's all free, but I need some more followers over there. I gotta catch up with Adam.
It's a good thing you don't care about social media, Lance.
Bro.
All right, Lance, thanks so much, buddy. Everybody else, thanks so much for watching.